Morning, everyone. This is Josh over at Azzad Asset Management. We'll be starting in just a minute. I see a couple folks trickling in right now. Give us about 1 to 2 minutes. Thanks. All right, ladies and gentlemen, thank you for being here. This is Josh Brockwell at Azzad Asset Management. Hope everyone is doing well. We'll go ahead and get the webinar started. Quick sound check, test 1, 2, test 1, 2. All right, and as we get going here, just a bit of housekeeping at the very top. Everyone should be aware that today's webinar is being recorded. Also, if in the unlikely scenario that you have somehow stumbled upon this webinar and you are a financial advisor looking for CFP board continuing education credit, and you have not signed up using our GoToWebinar registration link on our website or the one that was emailed to you, please hop off and take a moment to do that. That's the way we are able to determine your attendance, and we'll report that to the CFP board upon conclusion of the webinar today. All right, then with that, I'd like to welcome everyone to today's presentation on real estate investing. I am Joshua Brockwell. I'm Investment Communications Director here at Azzad Asset Management. So we get a lot of questions here at Azzad from clients and also prospects about the relative merits of investing in real estate, specifically as it relates to hard assets. And one of the things that we hope you're going to learn here today is that there are a couple of different ways to gain exposure to real estate as an asset class. That it's not just about owning hard assets, which can be both costly and really a headache when it comes to selling in a hurry and you're in need of liquidity. So let's get started. On your screen now is a brief slide about Azzad, sort of the word from our sponsor section of today's presentation. A little bit about us, so you know who you're hearing from today in case you are unaware. Azzad Asset Management is a registered investment advisor based in Falls Church, Virginia. That's where we're broadcasting from today, just outside Washington, D.C. Our mission focuses on generating competitive, long-term financial returns while using investment capital to promote a sustainable economy and a positive social impact. All of our products and investments comply with halal investment guidelines as established by the Accounting and Auditing Organization for Islamic Financial Institutions, also known as AOFI. We're a member of the Forum for Sustainable and Responsible Investment, or USCIF, and also the Interfaith Center on Corporate Responsibility. And thanks to those joining us from the ICCR conference in New York, if you're doing so today. Very quickly, we follow the 7 tenets of halal investing. Here at Azzad, these are our guiding principles for ethical money management. See them on your screen there, from filtering your investments according to our Islamic AOFI criteria, mentioned them just a moment ago, to calculating zakat or charitable giving for our clients. This is how we make sure that we're managing our clients' money in a Sharia compliant manner. And the last of the promotional slides here, just so everyone's aware, we manage 10 diversified portfolios and 2 40 Act mutual funds, which are sub-advised or externally managed by 7 portfolio management firms specializing in their asset classes. So let's start the conversation today about real estate investing with a graph. We put this together for our clients to show the historical performance of stocks versus real estate over the past 40 years. So it compares a hypothetical $10,000 investment in U.S. stocks, U.S. housing, and the D.C. real estate market, which is in our backyard. One thing you may notice is that the stock market has soundly beaten the real estate market. These are the hard assets I was referring to before. This is something to keep in mind for investors who are reluctant to think about investing in stocks. And as a reminder, of course, past performance is not an indicator of future results. So for many people, investing in real estate has been synonymous with buying a home. For years, opportunities in commercial real estate, either indirectly through real estate investment trusts or directly through private transactions, were classified as alternative opportunities that were mostly available to institutional investors. Today, though, real estate investing has gained much more popularity among investors around the globe. With increased access to commercial real estate through REITs or real estate investment trusts, competitive historical performance, and potential diversification benefits, this once alternative sector has now taken a place in a diversified investment portfolio. We'll now talk about equity REITs. So a real estate investment trust, or a REIT, is a company that owns, operates, or finances income-producing real estate. REITs provide all investors the chance to own valuable real estate, present the opportunity to access dividend-based income and total returns, and help communities grow, thrive, and revitalize. REITs allow anyone to invest in portfolios of real estate assets much in the same way that they would invest in other industries, through the purchase of individual company stocks or through a mutual fund or sometimes an exchange-traded fund, also known as an ETF. The stockholders of a REIT earn a share of the income produced through real estate investments without actually having to go out and buy and manage or finance property. More than 80 million Americans today invest in REIT stocks through their 401ks and other investment accounts like those that we offer here at Azzad. Most REITs operate along a straightforward and easily understandable business model. By leasing space and collecting rent on its real estate, the company generates income, which is then paid out to shareholders in the form of dividends. And REITs must, by the way, pay out at least 90% of their taxable income to shareholders. Most pay out 100%. In turn, shareholders then pay the income taxes on those dividends. So there are different types of REITs. We'll start, as I said, with equity REITs. Equity REITs are responsible for acquiring, managing, building, renovating, and selling real estate. Equity real estate investment trusts' revenues are mainly generated from rental incomes from their real estate holdings. Equity REITs typically invest in office and industrial, retail, residential, and hotel and resort properties. The equity REIT is the most common type of REIT out there today, An equity REIT may invest broadly, or it sometimes might focus on a particular segment of a market. Mortgage REITs, on the other hand, are a different animal. Contrary to equity REITs, mortgage REITs generally lend money to real estate buyers, or they acquire existing mortgages or mortgage-backed securities. While equity REITs typically generate their incomes from renting out real estate, mortgage REITs mainly generate their revenues from the interest that was earned on those mortgage loans. Because we follow halal investment guidelines here at Azzad that prohibit us from profiting from interest, we consider only equity REITs for investment. So let's look at some historical performance. REIT return characteristics make REITs an attractive choice for a diversified portfolio, as I mentioned at the outset. From a pure return perspective, REITs have had an attractive compound annual return of 11.5% since 1972, placing them between large and small cap stocks, which you see on your screen there. The performance depicted here assumes a reinvestment of all income, and I should mention it does not account for taxes or transaction costs. As the REIT industry has grown, REITs have exhibited performance behavior that's unique. While they offer the income earning potential of bonds and the price appreciation of stocks, REIT returns have had a low correlation to bonds and a moderate correlation to stocks. Their unique trading characteristics and their potential for good income and price return could make them a viable investment for those investors who are looking for further diversification and income. And I should also mention that diversification, of course, does not eliminate the risk of experiencing investment losses. Compliance likes it when I say that. Let's keep chugging along here with some performance, long-term performance. So on your screen now is a 47-year examination of past capital market returns. It provides historic insight into the performance characteristics of various asset classes. The graph on your screen right now illustrates the hypothetical growth of a $1 investment in 5 asset classes plus inflation over the time period of January 1st, 1972 through December 31st of 2018. So what you might glean from this is that REITs and stocks have provided the highest returns and the largest increase in wealth over that time period that we've analyzed. And as also illustrated by the image, REITs provided the largest growth overall, followed by domestic and international stocks. Among fixed income investments, bonds appreciated considerably, but still finished behind stocks, and treasury bills there offered only a fraction of the growth provided by REITs and stocks. However, the higher returns achieved by stocks and REITs also come with certain risks, which can be identified by the volatility or fluctuation of the graph lines there. You'll notice it's not a solid line moving consistently up and to the right. Now that we've had a chance to soak that in, let's talk a little bit about income from REITs. So the income generated from real estate investment trusts has proven to be relatively consistent over time based on our findings. The image on your screen right now illustrates the income return and price appreciation of REITs on an annual basis since 1999. So while REITs can offer the potential for good price appreciation, we should mention they're not guaranteed, and the price return can fluctuate widely from year to year. However, the income generated from REITs has been relatively stable and consistent. The average annual income return of the FTSE Nareit All Equity REIT Index from 1999 to 2018 was 5.3%. So here again, we should say that REITs can serve as part of a growth investor strategy while also helping to seek the income return requirement for those income-oriented type investors. Some portion of a portfolio may be appropriately allocated to REITs for a broad range of investor types. Let's talk about REITs as retirement income vehicles. Investors often think of REITs as a capital appreciation vehicle or a tool for growing portfolio wealth, which they can be. Little do some investors realize, however, that REITs can also be an income tool. This is especially relevant for investors seeking to manage their portfolios in retirement, when that need for current income takes precedence over the need for capital accumulation. So the image on your screen right now illustrates that income potential, specifically as it relates to bonds, REITs, and stocks from 1972 to 2018 again. The figures in the bars represent the portion of total return that can be attributed to income return versus that capital appreciation over time. Note that 56%, of the total return for REITs can be derived from income potential. So here again, REITs can serve as part of a growth investor strategy while also helping to seek the income return requirement for income-oriented investors. They can play an important role in retired investors' portfolios because of their high potential to generate income. Let's talk a little bit about correlation. So the correlation of REITs to stocks and bonds, your traditional stocks and bonds, has been generally declining over time. This has to do with how well two particular investments move in sync with one another. The higher the correlation, the more they tend to move in lockstep. So again, the correlation of REITs to stocks and bonds has generally been declining over time, but it's begun to rise again in the last few years. Most recently, correlations with REITs seem to be declining. The less investments are correlated with one another, the greater the diversification benefits to be gained from combining them in a portfolio you want. Some investments that zig while others zag. The image on your screen right now shows you the 60-month rolling correlation of REITs to small stocks, large stocks, and bonds. Over a longer time frame, correlation has been on a general decline, as I said, but recently it's risen pretty dramatically, most likely because of the way most asset classes went down in unison during the 2007-2009 financial crisis. In the past, the lower correlation of REITs to the two stock series illustrated the idea that REITs no longer traded like stocks and had taken on a unique trading pattern. On the other hand, the recent negative correlation with bonds may have helped with portfolio diversification. And here again, I should mention that diversification does not eliminate the risk of experiencing investment losses. But that provides some interesting context and color around the issue of REITs as they compare to other investment asset classes. Let's take a look at the potential of REITs to reduce risk and increase return. So if you add REITs to a portfolio of stocks, bonds, and cash, you can potentially, I should say, improve portfolio performance. The image on your screen right now illustrates the risk and return profiles of 3 hypothetical investment portfolios. Adding a 10% allocation to REITs in a stock, bond, and cash portfolio increased return from 9.8% to 9.9% and decreased risk from 10.1% to 9.6%. Including 20% REITs in the portfolio further improved return to 10% and lowered risk to 9.4%. I'll mention here that Sharpe ratio is a statistic that measures the reward to variability ratio. This is kind of more technical, but something to very quickly point out here for those financial advisors in the audience. We use the Sharpe ratio. It's particularly useful in comparing investment options to see how much return you could get for the level of risk incurred, which is the return per unit of risk. As we illustrate here the Sharpe ratio increases as REIT allocations increase in this example. Of course, I'll mention here again, it's important to keep in mind that diversification does not eliminate the risk of experiencing investment losses. Moving right along, adding REITs to a fixed income portfolio can potentially improve performance for those fixed income-oriented investors in the audience today. The image on your screen illustrates the risk and return profiles of 3 hypothetical investment portfolios. Adding a 10% allocation to REITs and a fixed income portfolio increased return from 8.2% to 8.6% and decreased risk from 11% to 10%. Including 20% REITs in the portfolio further improved return to 9.1% and lowered risk to 9.5%. So here again, demonstrating the benefits of diversification, specifically with respect to adding REITs to an investment portfolio. Moving right along, let's talk about retirement portfolios. So the inclusion of REITs in a retirement portfolio may increase the age to which the portfolio might last. So the image on your screen right now illustrates the estimated age to which portfolios, this is a $1 million initial value, with various allocations to REITs may last given a certain withdrawal rate. So think about a scenario where an investor retiring at age 65 withdraws 4% of his or her initial portfolio amount each year. A portfolio consisting of 45% stocks, 45% bonds, and 10% cash would last until age 92. This number increases by 3 years for a portfolio comprised of 40% stocks, 40% bonds, 10% cash, and then 10% REITs. Further, the portfolio with a 20% allocation to REITs would last until the investor is 97 years old, according to this illustration. So while including REITs may potentially improve the ability of a portfolio to support required withdrawals over a longer time period, again, the recommended percentage is usually around 4%, it's also important to note that a higher rate of withdrawal would exhaust those retirement savings sooner. Next up, sometimes we meet clients who are more interested in owning real estate directly, as I mentioned at the top, than investing in stocks. And although there are certain similarities between direct real estate and equity REITs, which we've been talking about, each one has unique features that may be appealing investment choices to certain investors. So these next few slides are going to show you some of those advantages and disadvantages of investing directly in hard real estate. So risk and return are 2 very important factors to consider when making any investment decision. The inclusion of REITs and real estate investments in a portfolio generally has a positive effect of lowering volatility as a result of portfolio diversification. The image on your screen right now shows that an investment in direct real estate did offer a significantly lower risk level when compared with both domestic and international equities. Direct real estate is on the far left of your screen. An investment in REITs offered less risk than small stocks and international stocks, but slightly more risk than large cap stocks. Since 1985, direct real estate investments in REITs have had a risk level of 8.5% and 17.9%, respectively. In comparison, the risk levels for domestic and international equity investments range from 15.9 to 21.8%. So food for thought there. Real estate has also experienced a narrower range of returns. So the range of average or annual returns for direct real estate investments differs from the range of annual returns for REITs and large stocks. Returns from both REITs and investments in direct real estate or hard assets are generated from the cash flows of the properties. A combination of dividend yield and share value appreciation has made REIT returns competitive with equity investments. The image on your screen right now compares the range in annual returns of direct real estate, REITs, and large stocks since 1985. The compound annual returns and the ranges of returns for large stocks and REITs were similar, as you see on your screen. The compound annual return of direct real estate over the same time period has been lower than that of both large stocks and REITs. Direct real estate, however, experienced significantly lower downside risk when compared with REITs and large stocks. That's a truism. The lowest return for direct real estate since 1985 was minus 18.1%, compared with minus 37% and minus 37.7% for large stocks and REITs, respectively. On account of higher barriers to entry and greater liquidity risk, investing in direct real estate may not be suitable for all investors. If it's deemed appropriate, direct real estate may potentially provide additional insulation in tougher market conditions due to lower downside risk. I told you the section was about the pros and the cons of investing in hard assets and REITs, and we're seeing some of that on the screen right now. I'll also mention that returns and principal invested in stocks and REITs are not guaranteed. Stocks have been more volatile than other asset classes. So the grid on your screen right now illustrates the key differences and similarities between the different real estate markets. The returns across REITs and directly held real estate are competitive with many traditional asset classes. Both asset classes exhibit low to moderate correlations to common stock and bond asset classes. Diversification benefits stem from this property of low correlation. One feature of REITs is that distinctive from direct real estate, one feature of REITs that is distinctive from direct real estate or hard assets is the amount of financial information that's publicly available, which is important from a price discovery perspective and getting as much information about an investment that one can. I'll also mention that direct real estate trades in a private asset market and often allows for the ability to target desired properties, unlike REITs. REITs, though, are more liquid than direct real estate investments, which is one of their primary advantages. As a result, direct real estate investments carry more liquidity risk. Lastly, remember that returns and principal invested in REITs are not guaranteed. REITs typically provide high dividends plus that potential for moderate long-term capital appreciation that we talked about before. And as we talked about before, a reminder that a REIT must distribute at least 90% of its taxable income to shareholders annually. And generally speaking, real estate investment options are subject to certain risks, such as risks associated with general and local economic conditions, interest rate fluctuations, credit risks, liquidity risks, and corporate structure. If you're interested in taking advantage of the benefits of owning those equity REITs, I'll also point out very quickly that Azzad can help. Our REIT strategy is one of 11 used by our advisors to create investment allocations for our clients, and we're happy to talk to you about those more. You can also learn more on our website at azzadfunds.com. So now for the second half of the presentation, we're going to turn to how we analyze REITs, how one could analyze REITs using our investment methodology here at Azzad. To do this, we're going to be using the Azzad REIT portfolio, which is one of our 11 investment options that we offer to clients. It's going to be an illustrative example for us as we go about the equity analysis portion. So we'll talk a moment about strategy and philosophy of the Azzad REIT portfolio. You'll see a few bullets on your screen that explain high level what the product is. Regarding strategy and philosophy, our investment committee is going to look for companies using a bottom-up investing approach. So we consider the macro environment as far as what's happening in that sector overall. While we tend to favor large cap REITs, we do include mid and small caps whenever they meet our fundamental research criteria and are what we believe to be best in class. We also focus on investing in companies with sound fundamentals and companies that are leaders in their sectors. So we won't invest in a company just so we can cover a particular sector, I should say, nor simply because it passes our screens. This means no mortgage REITs due to their involvement in interest and debt, as I mentioned earlier. So a candidate for our REIT portfolio has to be a leader in its sector, and we have to be convinced that it will be a leader in the next 5 years as well. We start with the entire REIT universe and screen out all of those investments that fail ISFA, which is our in-house proprietary investment screening and filtering application that we use to determine a list of Sharia-compliant investments or candidates for investments. The portfolio won't hold more than 30 stocks, and it's going to be less when REITs are highly leveraged. So we're going to be getting into some nitty-gritty over the next few slides regarding analysis, and we've tried to summarize this as best as possible, but if folks do have particular questions about methodology or process, feel free to reach out to us after the webinar. We'll hit this very high level, and apologies if I go quickly. The 7-factor analysis is what we use for our REIT portfolio. Our investment committee looks for companies using that bottom-up investing approach I mentioned before, looking specifically at fundamentals of the company and then considering secondarily the overall macro environment. While we tend to favor large caps, we do include those mid and small. As I mentioned before, we're going to talk specifically in the next slide about our quantitative factors. So let's move on to that. Excuse me, qualitative. Here we are. So many portfolio managers involved in selecting REITs are going to look at these qualitative factors first, just like we do. The first one on your screen there is management team. So at Azzad, we look at their track record and their experience in real estate. Are they any good at what they do? We try to determine that. And we also try to understand the REIT's business, which is the second item you see on your screen there. So we ask ourselves questions like, what kind of real estate does it own? Where does it own that real estate? That's related to geographic diversification. We're looking at what kinds of tenants it leases to, and those tenants representing what percentage of its business. We'll also ask ourselves questions about an occupancy rate and try to determine things of that sort, because this all goes toward helping us understand the REIT's future cash flows and hopefully the stock price's potential. Also, while looking at some of the fundamentals, lastly on your screen there, we're comparing the REIT to its competitors. We're looking at what those REIT's main risks to business also are. So from qualitative, we'll jump to quantitative factors here. So first on your screen, FFO, funds from operations. REITs typically use this metric as opposed to EPS or earnings per share like other stocks. And we, like every other portfolio management out there looking at managing a REIT portfolio, will look at AFFO, which is adjusted funds from operations. This is funds from operations adjusted for depreciation and other expenses. It's a technical figure that's put out. REITs announce their FFO quarterly, and we look at the last 4 quarters of FFO, compare it to that REIT's competitors to see if it's a strong candidate in its sector, and then make a determination for investment from there. We'll also compare the AFFO to the REIT's annual dividend payouts to get its dividend coverage ratio, which you see on your screen there. as bullet number 2. This lets us know how sustainable a REIT's income really is over time. Just because a REIT has a high dividend yield doesn't make it a good income stock. We need to make sure that the REIT is earning more in rental income than it's paying out in dividends. It's important as a consideration for a portfolio manager. We also want to make sure that we aren't overpaying for a REIT. So we come up with a valuation for the stock based on some assumptions. We also maintain a watch list of promising candidates, and we're waiting to buy them at more attractive prices. So the same list can include REITs that are on the edge of being compliant with our screening criteria, but barely hanging on because of debt to market capitalization being something in the range of 28, 29, 30%. We like debt to market cap to be even lower so that we can be more confident we'll be able to hold on to it for the duration, or at least for a good while. Lastly, when we create the portfolio, we optimize it and look at factors like beta compared to its benchmark. We don't want to be riskier than the S&P 500, for example. And we also strive to create a portfolio that's less risky than the S&P 500, but has more potential for return. Now, of course, we're also aware of the dividend yield compared to the S&P 500. If we can get it to match or exceed, then that's great. But sometimes ISFA, our screening software, and our fundamentals don't necessarily allow that. Let's talk about sell discipline for a moment here, how we decide when to sell. So the question is, when will our investment committee decide to eliminate a REIT from the portfolio? We will sell a stock when it fails Azzad's ethical screening criteria, if its fundamentals deviate enough to make our original investment thesis void, and if there's a better opportunity. Typically, if we get another watch list stock that finally passes our screens, we'll trim from existing holdings to be able to get into it. We maintain anywhere between 1 to 5% cash in our REIT portfolio. And it should also be noted here that we believe it's an exciting time to invest in REITs since interest rates are low. You know, we're in the middle of a Fed announcement today as well, so something to keep in mind. REITs took the opportunity to get rid of a lot of their debt because of low interest rates, and in some markets we had as few as 12 holdings. Now we have almost 30 because of some of that deleveraging that's gone on. So that's given us more investable opportunities and candidates for us to pick from. And that's actually a pretty nice segue into our screening criteria, or at least it gives me an opportunity to explain in broad strokes how we operate at Azzad. So obviously, as I mentioned at the outset, we're not buying heavily indebted companies or REITs that are involved in interest and traditional mortgage-backed REITs, mortgage lending. So, and that also includes overly leveraged REITs. So all of this factors into our investment analysis and makes up some of the criteria that we use for selecting candidates for investment in our REIT portfolio. And we have a 3-layered sort of Sharia compliance process here at Azzad. It begins in-house with our internal Sharia auditor. We have a certified Sharia auditor and advisor on staff who is our day-to-day in-house compliance officer and will adjudicate a lot of those disputes or issues that may arise. Occasionally, we'll need to kick that up to our active Sharia advisory board. Those 3 individuals you'll see on your screen as well. These are folks that meet regularly, are issuing guidance, and folks that we rely on to make sure that we're following those AOFI guidelines that we mentioned at the outset. AOFI, again, being the accounting and auditing organization for Islamic financial institutions. And then to top it off, we want to make sure that both our in-house advisor and officer, as well as our active Sharia advisory board, are following the letter of the law. So we bring in an independent auditing firm to look at our processes and our books every year regarding Sharia compliance, and we have those individuals issue an opinion letter. So we're getting an annual verification of our compliance. So it's the 3-layered approach to Sharia compliance and governance. we'll turn now to a brief word about self-directed IRAs. We wanted to include this in the presentation today because it's a subject that we've seen some of our clients deal with. Self-directed IRAs can be advantageous, but they also come with a lot of pitfalls, one or two of which I'll touch on in just a moment. So an individual retirement account, just to give you a little background, provides investors with certain tax benefits for retirement savings for those who aren't in the know. And some common examples of IRAs include the traditional IRA, the Roth IRA, Simplified Employee Pension, or SEP IRA, and Savings Incentive Match Plan for Employees, or Simple IRA. All IRA accounts are held for investors by custodians, and those custodians can include banks, trust companies, or any other entity approved by the IRS to act as an IRA custodian. Most IRA custodians limit their holdings in IRA accounts to firm-approved stocks, bonds, mutual funds, and CDs. However, a self-directed IRA, again, this is background for the uninitiated here, is an IRA that's held by a custodian that allows investment in a broader set of assets than is permitted by most IRA custodians. Custodians for self-directed IRAs disclaim most duties to investors and may allow those investors to invest retirement funds in alternative assets, quote unquote. Some folks consider that to be real estate, promissory notes, tax lien certificates, private placement securities, things like that. I'll also point out here very quickly before we transition to the next slide that according to a recent SEC investor alert, and this is a quote, investments in these kinds of assets may have unique risks that investors should consider. Those risks can include a lack of disclosure and liquidity, as well as the risk of fraud. So self-directed IRAs are permitted by the IRS, as I mentioned just a moment ago, but just because something is allowed by the IRS does not always mean it's the best choice for a portion of your retirement savings. Among several pitfalls that clients and others should be aware of are what you see on your screen there. First up, lack of diversification. One of the biggest risks of owning real estate in a self-directed IRA is the potential lack of diversification. A lot of folks try to own those directly held assets, those hard assets in their self-directed IRAs, and they end up getting burnt because they're not diversified, and also because of number two, liquidity. Although it's not impossible, many investors lack the ability to create a diversified real estate investment portfolio with those self-directed IRAs. Liquidity is a big concern when investing in real estate through that IRA. There's always the possibility that an investor may not be able to access the value of that investment to make distributions, for example, when they need the money, when they want to make most of it during their retirement years. So important considerations for owning real estate inside a self-directed IRA. Lastly, taxes. Owning real estate in an IRA allows your investment to grow on a tax-deferred basis, which is great. Roth IRAs provide the potential for tax-free growth. However, if you don't follow the rules and purchase property the wrong way within an IRA, you could disqualify that IRA and create a taxable event. IRA ownership of investment property also loses some of the tax breaks available to real estate investors if the property operates at a loss. You also can't claim depreciation on IRA-owned real estate. So talk to a tax advisor before looking into this. Talk to your Azzad advisor about investment options maybe other than hard assets, specifically the real estate investment trust portfolio that we featured earlier. These are important considerations to keep in mind. I'll also mention that if you're thinking that an IRA could be used to purchase a vacation home or a primary or secondary residence, think again. Self-directed IRA investment transactions involving real estate must all be arm's length transactions. That means that self-dealing or personal transactions are allowable within self-directed IRAs. That means no self-dealing or personal transactions. This rule also applies to immediate family members, so don't think you can buy or sell a property to or from a family member or yourself unless you want to create, again, a taxable event. I'll also mention unrelated business income tax, UBIT. That's another potential tax issue. Again, consult a tax advisor for advice specific to your situation. It's important to pay attention to UBIT if you are thinking about the use of a mortgage to purchase an investment property as well. Also, with a traditional IRA, you must take required minimum distributions when you reach age 70 and a half. If you own real estate inside an IRA, it's very difficult to sell off those real estate holdings in small chunks each year. And that's the reason you have to have enough cash in your IRA accounts to cover your required minimum distributions in order to avoid tax problems. So, as I'm sure you have seen, investing in real estate comes with a lot of potential pitfalls, and individual investors should always talk with a professional before going this route. So on your screen right now, some important information that our compliance department likes for us to pass along. We will at this point take a question or two. Only got a little bit of time left. We're trying to conclude within the hour, and you can chat with us or specifically ask a question using that question box on the GoToWebinar control panel. Take a look at those in just a moment and give everyone a moment to ask a question, to absorb, process a lot of information we've passed along to you this morning. We know it's a lot. And we'll start here with a question about, this is about Azzad's real estate investment trust portfolio. And it has to do with specifically how it's allocated currently. I'll point out to everyone before I get into the meat and potatoes of the strategy, how it's allocated, and some of the moves we've been making within the portfolio of late. You'll always be able to see a copy of the real estate investment trust portfolio fact sheet. The REIT fact sheet is available at azzadfunds.com. So visit our website, check that out. You'll be able to download third quarter fact sheets shortly, probably within the next week. Those will be updated. Right now, you'll see 2Q on there. It'll still, regardless, give you some good information about the product. And now I will answer that question about how the strategy is positioned, and we'll have to be general about it. But right now, I would say that we're underweight in brick and mortar retail in the REIT portfolio, the Azzad REIT portfolio, especially malls. But that doesn't necessarily mean that all retail real estate's bad. So, for example, when REITs lease out grocery space, or residential properties that are anchored by retail stores, that's usually a good prospect for us. We find those to be doing relatively well. So as far as our investment process is concerned, though, we usually look for unique businesses. So as an example of that, we hold a position in a REIT that stores perishable food for restaurants and grocery stores. It's the only one of its kind, which gives it a good market position. So that's an important consideration. We talked a little bit about that process earlier. We look at competitors. We also recently, I can mention, increased our healthcare weighting in the REIT portfolio, because although the demographics support nursing homes, et cetera, those stocks have not done terribly well in this very long bull market. But we believe once that market becomes more efficient and we move to a different phase in the business cycle, those types of REITs, we expect them to help reduce some of the volatility in the overall portfolio, which is an important consideration for our clients. That's also the case with manufacturing homes, which are also REITs, by the way. I might also mention, lastly, another very hot REIT sector are REITs that provide wireless infrastructure, particularly as we move to 5G. So within this sector, we're actually diversified among a company that has over 70% of its customers in the United States and another one that has around that same amount overseas. Last but not least, I'll mention that we also want to make sure that our REITs that lease office space for example, have tenants who lease for longer periods, and that gives us assurance, hopefully, of its future growth. So those are some of the considerations to answer that question about how we position the REIT portfolio. With that, we are bumping up against the top of the hour. I do see another question here on our screening process and how diligent we are when it comes to Sharia compliance and equity investments in general. I would refer the questioner to AOFI, the Accounting and Auditing Organization for Islamic Financial Institutions. They really set the standards. Literally, they issue a big, thick textbook, and they're coming out with new standards constantly on investment in equities and stocks. Also, things related to Islamic insurance, takaful, which we're not involved in, but also related to zakat and purification calculations, which we very much are involved in. And so we don't really make the rules at Azzad. We follow them, I should say. And I think I mentioned in our slide on the 3 layers of Sharia compliance how we do that. But again, I would encourage you to visit AOFI, learn about their process. They really are the gold standard for the Islamic finance industry globally, and we consider ourselves to be incredibly diligent, and we hold ourselves to a very high standard when it comes to making sure we uphold those AOFI rules. Again, we don't make the rules of Islamic investing here at Azzad. We follow them, and we try to make sure that we're doing that through those 3 layers of Sharia compliance. I think diligence, if you look back at our 7 tenets of halal investing that I showed at the outset of today's presentation, you'll see these are the principles that we live by, that we follow, and we consider ourselves to be authentic. And there's really no better way to put it than that. And we would encourage you to compare us to others out there. We don't think you'll be disappointed. So with that, I'd like to thank everybody for attending today. We appreciate your time. We appreciate the fact that you've given us an hour of your time. And again, for those who are registered for today's webinar using CFP board ID numbers, we'll be passing along that information to the CFP board to get your continuing education credit, and we'll also be issuing a certificate from Azzad as well to attest to your attendance today. So thank you all for being here. If you have any other questions, as I mentioned, please visit us at azzadfunds.com. We're happy to answer any other questions you might have offline. You can always give us a call at 888-86-AZZAD, and have a great rest of the day, everybody. Thank you for attending.